The interest rate is the amount that is charged by the lender for the use of assets or principal. The assets borrowed could be cash, consumer goods, vehicle, or building, etc. Interest rate is normally noted on an annual basis known as annual percentage rate, APR. Other interest rates apply over different periods, monthly or daily basis. Banks charges interest rate from its borrowers and pay its depositors. The interest charged from borrowers is slightly higher than that paid to the depositors, so that the bank can make profit. The borrower will usually be charged a lower interest rate if it is considered less risky. Similarly, if the borrower is considered high risk, the interest rate charged will be higher. Individuals take loans to purchase homes, launch or fund businesses, pay for tuition fee or fund projects. Businesses take loans to purchase assets, expand their operations or fund capital projects or acquire new machinery, etc. The borrowed amount is then repaid either in lump sum or in periodic installments. The repaid amount is higher than the borrowed amount as it also includes the interest charged. Basic types of interest rate. Annual percentage rate, APR. The APR is the amount of total interest, expressed annually on the total cost of the loan. APR is calculated as the prime rate, plus the margin the bank or lender charges the consumer. The result is annual percentage rate. Credit card companies often use APR to set interest rates when consumers agree to carry a balance on their credit card account. Simple interest rate. Simple interest is interest, calculated on the principal amount of a loan. It is an easy and quick method of calculating the interest charge on a loan. The formula for calculating simple interest is: simple interest is equal to principal multiply interest rate multiply time. Consider an individual taking a $200,000 mortgage from the bank with an interest rate on the loan at 15%, and the repayment period of 20 years. Simple interest is equal to 200,000 multiply 15% multiply 20 is equal to 600,000. So, the total amount that has to be paid to the bank will be $600,000 in 20 years for the borrowed amount of $200,000. Compound interest. Compound interest is the interest calculated on the initial principal, including all of the accumulated interest from previous periods on a deposit or loan. The rate at which compound interest accrues depends on the frequency of compounding. The higher the number of compounding periods, the greater the compound interest. The bank assumes that at the end of the first year the borrower owes the principal plus interest for that year. It is also assumed by the bank that at the end of the second year, the borrower owes the principal plus the interest for the first year plus the interest on interest for the first year. Compound interest is calculated as: compound interest is equal to P multiply 1 plus interest rate, N-minus-1, where P is principal, N is number of compounding periods. Consider an example of a loan of $300,000 taken from the bank at the interest rate of 15% for a period of 10 years.